Hello and welcome to the Genuine Learning Blog. My name is Melisa Galasso, and today we're going to take a look at a proposed ethics interpretation from the Professional Ethics Executive Committee, or PEAC, around alternative practice structures. You may remember last year in 2025 when we did a blog on an invitation to comment that PEAC had put out around alternative practice structures. And they kind of offered us two alternatives. One where they provided authoritative guidance around APSs, in particular private equity, or non-authoritative guidance. Ultimately, the PEAC decided in December to put out authoritative guidance in this area. And so we're going to cover the proposal. So this is proposed revisions again. So we already have alternative practice structures in the interpretations, but it's going to be from a different perspective. So proposed revisions related to alternative practice structures. It was issued on December 29th. And again, the real type of alternative practice structure that they're addressing is private equity. So the original guidance around alternative practice structure stems back from the late 90s, early 2000s, and private equity really wasn't contemplated basically when they put the existing interpretation together, and how private equity is structured is impacting how we understand, what is a firm, I guess, today. And so they're going to provide some new definitions. They're going to walk us through a process of making an evaluation around independence. And they're also going to provide us with some concepts of threats and safeguards. So let's start with our definitions. So what is an alternative practice structure? It is a form of organization which a firm that provides attest services, which we're going to call the attest firm, is closely aligned with another public or private entity, partly or wholly owned by an investor or investors, that performs professional services other than attest services. And we're going to call that the non-attest entity. So in this scenario, when we think about this, very often a current CPA firm, that's one firm, will decide to have an investment from a private equity. And what they'll typically do is they'll take the firm and they'll break it into two pieces. They'll have the attest entity, because many states have rules around who can own an entity that does attest work, and they have to be CPAs in a certain percentage, et cetera. And then the non-attest entity. And the PE will only invest in the non-attest entity. However, the relationship between the attest entity and non-attest entity is very strong, because all of the HR and all of the marketing and all of the IT sit in this non-attest entity. And they basically have an operating agreement between the two that provides these services, and then the attest firm pays for them. And so they're very, very, what we call closely aligned. So what does it mean to be closely aligned? It means a substantial amount of revenue of the attest firm is paid to the non-attest firm in return for administrative services and the lease of employees, equipment, office space, and other resources. So again, they often have common branding, similar names, and there's this movement back and forth between the two entities. And so when we have this agreement, they are closely aligned. It is an alternative practice structure. So we're kind of envisioning this investor, this private equity, but we also look at public companies, et cetera, that are making these types of investments. The other thing that's important here are what we're going to call upstream entities, right? So when we look at who else is involved in this puzzle, upstream entities of the non-attest entities are entities that have at least significant influence over the non-attest entity through an investor, right? So when we're thinking about private equity, the investor has at least significant influence over the non-attest entity, including the fund, investment advisor, general partner, and PE firm, right? So they have some type of interest, sometimes controlling, sometimes minority, but at least significant influence. What I loved about the proposal is that they do provide quite a few examples here. So this is a diagram that depicts an example of an alternative practice structure. And you can see here we have an investor, doesn't say what type of investor, but they have at least significant influence or controlling investment in the investee. That investee is the non-attest entity. And you can see here, we have the CPA firm in sort of white who have all the CPA partners, right? Because you have to be a CPA to own the CPA firm. But then they have this non-attest entity that has all of the other people. So you'll have potentially, you can have your consulting in here, your bookkeeping, your CAS, all of the other services that are being provided, including tax. Sometimes, depends on how they set it up. But they have this non-attest entity. And you can see here, there are some CPA firm partners who are involved, but then we have non-attest entity principals, people who are not CPAs, and then these other investors. And you can see here the investor has this relationship with the investee. However, they also have shareholders and owners and other investees as well, right? And so that's the relationship that we're sort of looking at here. And number 4, as you can see this, is that compensation between the two entities. And that's what makes them closely aligned. Now it can get more complicated, as you can see here. So this is also an alternative practice structure. And now we have a PE investor specifically that has the significant influence or the controlling investment. But you can see there's these fund managers and all of these different things that have to be considered here. And you have the PE owners, you have the private equity firm, you have the different funds that own different pieces. And then again, you have a portfolio company here that has a relationship with the CPA firm. But it can also look like a public company. So this is an example of a public company investor that has either significant influence or controlling investment in the non-attest entity. So you can see here, they are doing broker-dealer work, they're doing insurance, they're doing other financial services, and then they have this advisory that has that close relationship with the CPA firm, right? And so basically, lots of different ways. There's not one structure, lots of different ways to have that closely aligned and that significant influence or control. And so what are we looking at here? So we have a rule, a proposed rule. Members operating in an alternative practice structure should perform the following steps when identifying and evaluating relationships to comply with the independence rules and its interpretations. So the first one is determine which entities are network firms of the attest firm by first applying the network definition and then applying the network firm definition. So we're going to start through some of the language here within concept of what is a network. And then once we have who is involved, right, we already have these concepts, we're going to look at what individuals are covered members, right, people who now we have to evaluate for independence. And then we're also going to identify relationships and circumstances that create threats to independence. So this is sort of the overall process. It is a principles-based approach, but there are some prohibitions, right? So they do come out and tell us that threats to compliance with the independence rules are not an acceptable level and cannot be reduced to an acceptable level through the application of safeguards, and therefore independence would be impaired in the following scenarios, right? So first, if I have significant influence investment or controlling investment, when an individual who is a member of those charged with governance over the non-attest entity serves in a key position at an attest client during the period of professional engagement or the period covered by the financial statements, right? So again, you don't always have a financial statement when you're doing a test work. You can be doing an examination. You could be doing a review, right? So in this scenario, if we have this investment and an individual who's a member of those charged with governance over the non-attest entity is in a key position. So they're either going to be, on the engagement team or someone on the engagement team reports up through them. In addition, in a significant influence investment or controlling investment, when an attest client or an affiliate of a financial statement attest client is an upstream entity of the non-attest entity, or when an attest client has, or the attest client's officers or directors have a direct financial interest in the non-attest entity or a beneficial ownership interest of more than 5% of the equity of the non-attest entity, independence would be impaired regardless of whether the attest client has significant influence over the non-attest entity. And then in a controlling investment, when the investor either has significant influence over the attest client and the attest client is material to the investor, or obviously control of the attest client. All right, so we do have some prohibitions here, but if it's not prohibited, then in those scenarios, you would have to make also a principles-based approach using the threats and safeguards. So in both a significant influence investment and controlling investment, members should evaluate whether a relationship that's not prohibited, right, and its interpretations here create threats that require the member to apply safeguards to reduce the threats to an acceptable level. If you can't apply a safeguard, then obviously independence would be impaired. So they provide certain rules and then certain principles in this area. And another one of my favorite diagrams that came out of here is taking a look at that concept of a network and whether you're a network firm or you're in that network. And so you can see here they have a couple of different steps that you would go through to make that determination. So this is definitely a must read for those of you who are interested in how private equity in particular is impacting independence. And if you are so moved, comments are requested by April 30th of 2026. And it's a simple email that you can send to the Professional Ethics Executive Committee. It's ethics-exposuredraft@aicpa.org. All right. Well, we covered quite a bit on today's blog. Hopefully you found this at least interesting. I know I'm always, I enjoy reading the articles and the newsletters and the papers that are coming out about some of these relationships and how, PE is impacting the CPA profession. So again, my name is Melisa Galasso. It was a pleasure having you on the blog, and I look forward to seeing you on a future blog. Have a great day, guys. Bye-bye.